Welcome to the Money and Wealth Show, brought to you this week by American Manganese Incorporated. Here's your host, Sterling Fox.
Welcome to the Money and Wealth Show, where each week we bring you opinions on business, the economy, and the markets. And this week's guest has plenty of opinions. He is the editor of Kaiser Research Online. Joining us from San Francisco is John Kaiser. John, welcome to the show.
Thank you, Sterling. It's a pleasure to be here.
Well, it's good to have you with us, and let's just take a second and let our viewers get to know you, because though you hail from San Francisco these days, you are a Canadian from British Columbia, from Vancouver.
Definitely born, bred, raised in Vancouver. I moved to the United States in 1994. I had married an American. She wanted to be closer to her family, so we moved down there, and she, of course, escaped the rain, and I got the sun in the process, and the internet came along, and I'm still very much immersed in the sector where I had trained and learned how the venture capital system works here and the junior exploration sector works.
Well, now that's the most interesting part about what you do. Mr. Kaiser is responsible for bringing junior Canadian mining ventures to the attention of his American clients. Why did you choose Canadian products for your American clients?
Well, when I was here working as an analyst for a brokerage firm, I was able to take advantage of the disclosure systems that were emerging in Canada. And thanks to the Bre-X betrayal that we all suffered in 1997, the reporting system underwent a major reform here in Canada, 43101 system, and the CDAR internet filing system came on board. And now in the United States, I can continue to talk about this sector, which physically is located in places like Toronto and Vancouver, but everything is available online, and it is the best disclosure system for resource sector reporting in the entire world. And so I'm sticking with my expertise and taking advantage of what we have here in Canada.
Well, I wonder, John, how many of us actually know that about our mining stocks and how they are regulated and how are they compelled to show themselves to investors all over the world. In fact, we do the best job.
Yeah, I don't think it is widely understood amongst retail investors, but institutional investors definitely like the Canadian reporting system. In the United States, we have the OTC bulletin board system, and the companies there have a hard time getting the attention of serious, sophisticated investors and institutions unless they also achieve a listing on either the Venture Exchange or the TSX Exchange and become 43101 reporting issuers.
And it's this 43101 reporting procedure that all players in Canada are compelled to comply with that makes the big difference through the eyes of the rest of the world.
Yes, we have a what you see is what you get system, because not only are there detailed disclosures required, but they are now required to be signed off on by a qualified professional, which is a geologist who makes only his or her income from being paid for doing the work, has no shares, has no options, and so they have no incentive whatsoever to fib about what these results actually mean or are.
Interesting you would mention Bre-X, and as soon as you did, I could hear the eyes rolling through our viewing audio. Oh, brother, Bre-X. But in fact, while it stung a lot of us, and badly in many cases, the upshot of that whole fiasco was a much better marketplace now for Canadian players.
And it had huge implications, because around 2003, we came out of a bear market as base metal prices started to rise significantly as China came on stream, and the game switched from exploration, discovery exploration type work by the juniors to taking existing deposits and establishing their feasibility for development. And here, where you had big money coming into the sector, now the disclosures were important, and so the fact that 43101 existed helped the industry enormously. The timing was quite fortuitous.
Now, there's a couple of bits of jargon that we also need to straighten out here, because the word reserves and resource are words that we understand to be associated with mining companies and what they may or may not have found or already be pulling out of the ground, but they differ widely. So help us through reserve and resource as it's seen through this reporting.
Well, the first thing is the resource. And you start off with an exploration target. You get an intersection. It's got 50 meters of 8-gram gold. You get a number of intersections. If the spacing is close enough, you can do a calculation. How much is there? You start with an inferred resource. You do more detailed drilling, and you get measured and indicated resource. If you have an inferred resource, you can do a preliminary economic assessment, which is cost discovery. What does it cost? What is it likely to cost to get this out of the ground? Then you go to the pre-feasibility study stage where you do more detailed engineering of what's involved to get the metal out of the ground, and you need a measured and indicated resource for that. And so to publish a pre-feasibility study, you've got to do more detailed drilling, metallurgical work, and so on to support it. And then you finally get to the feasibility study, and when that is finished, you will have done enough economic work and detailed drilling to say you have a proven and probable reserve, a mineable reserve.
So a resource is what you think you have until you can prove that what you thought you have actually exists, at which point it becomes a reserve.
In a sense, it's a reduction of risk. You start off with 35% error margin, and you gradually reduce it down to 2 to 5% error margins. It's all about error margin reduction.
Okay, now there are some of the technical details important to the rest of this conversation. Our guest is the editor of Kaiser Research Online. John Kaiser is with us from San Francisco, and here's where the story is about to get interesting. Brace yourself for a ride on the wild side when we return with lots more here on the Money and Wealth Show.
Always consult your investment professional before making any investment decision.
American Manganese Inc. has a world-class deposit in Arizona, indicated 6.7 billion pounds, inferred 8.9 billion pounds, potentially the lowest cost producer of electrolytic manganese. American Manganese Inc. has a projected cash cost of 44 cents a pound. The metal trades near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
You're watching The Money and Wealth Show, archived online at TalkDigitalNetwork.com. Here's your host, Sterling Fox.
Welcome back to the Money and Wealth Show. Our guest this week is John Kaiser. Mr. Kaiser is the editor of Kaiser Research Online and also runs a website, John, called KaiserBottomfish.com. And this is where the fun begins. Mr. Kaiser, as I've explained earlier, sells or attracts American clients to high-risk Canadian mining ventures. And you use Canadian product now, we know, because we report cleanly and more so than any other country on earth. So, on your website, you actually use the word bet quite a few times, because for a lot of investors, this is high roller, crapshoot Vegas stuff. Who is a typical investor drawn to play in the game that you have on the field?
Well, hopefully, no investor is drawn to this sector, because investing is where you have a reasonably reliable rate of return to expect. And there were a lot of investors who bought mortgage securities and lost their shirt because this was supposed to yield 5-6%, which was a little better than the 4% that the T-bills were yielding. Those are investors. What I look for are speculators, people who understand risk, who can tolerate a loss and are looking for substantial rewards to offset that risk. And speculation, let's be frank, is gambling, because you're putting money down, betting on an uncertain outcome. You have an idea of what that outcome should be, and if you are right, then you make money. If you're wrong, you lose.
But I guess the attraction, John, ultimately it has to be, if you're right, not only do you make money, you make insane amounts of money, right?
It's not quite like winning the lottery, But if you can get 1,000%, 2,000% by having bet on a small exploration company that finds a 10, 20 million ounce gold deposit, well, that's an extraordinary return. And by the way, we were talking earlier about the Bre-X betrayal. Bre-X appeared to be that incredible success story.
It sure did.
20 million plus ounces. And the betrayal that resulted alienated a lot of retail investors from that sector. They never quite understood all the mathematics that went into the pounds and ounces in the ground calculations of the last decade. And they are dying for what I call the Bre-X redemption. The junior that comes along with a fantastic discovery that grows and grows and is real. And I think we're heading back into the type of market where the appetite for these sort of phenomenal exploration discoveries is going to go through the roof.
Now, John, is that because gold and silver and palladium are at all-time highs, likely to go continuing just up, 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 up? The conditions are right for the speculators and the junior players, the junior miners, to get together and get those drills in the ground?
Yes, there are two things that are going on. One, we are approaching the end of the ounce and pound in the ground development cycle, which has been the focus during the last 10 years. The metal prices have rebounded from their crash in 2008. They are strong. They may head higher yet in the cases such as gold. And the bigger companies are now swallowing medium-sized companies. Medium-sized companies are swallowing the smaller companies. And there's capital that's coming in from earning 0.5% on savings deposits, seeing the strength in the mining sector, looking for a much better return. They're starting at the top, and you have this capital now cascading literally down the food chain. And at the very bottom is the exploration play. Within 2 years, all these wonderful ounce and pound in the ground deposits will have been swallowed up by bigger companies. People will be cashed up, and they'll be looking to repeat these gains faster and even higher. And really, exploration plays are the discoveries are the only way you can make these kinds of off-the-scale gains that you alluded to that remind one of the, cowboy type.
Oh, absolutely, you bet. Now, typically, though, and we've now come to understand the difference between resource and reserve. So for a junior mining company, an exploration company, to go through the process of finding the resource, defining it, and actually proving it that indeed it is a reserve. There is a significant quantity of gold in them there hills. How much is it going to cost that junior miner to get to that point?
It depends on the size of the project. If you have a very high-grade vein system, it could be quite profitable to mine at a relatively small scale. It might only cost you $20 million to bring it to the point where you do a $100 million investment and put it into production. If you're talking world-class scale, it could cost you $100 million to bring it all the way to feasibility study, and then cost $1 billion to put it into production. So there is an enormous range linked to the size and nature of the deposit.
And these mining companies that you bring to the attention of your clients, are they in need of investment right from the get-go, or do they generally walk into the game with some cash on hand?
Well, the industry operates in the sense of rounding up seed financing from sophisticated investors who trust the management team. In this game, it's all about management quality. If management doesn't know how to generate a prospect and execute an exploration program, they are never going to find anything. So it starts with the seed round, then they do the dressing up of the play and show, well, here's the target and all that. They get another round of financing from others, they start drilling it. If the results start to confirm expectations and make the dream that has been mapped out by the big arm waving in the beginning start to look a little bit more real, or at least have some proper dimensions to it, then a whole new range of investigators, speculators who want to put bigger capital in, they come in, and ideally it just gets that the market cap of the company grows, the amount of money that they raise represents less dilution to it, and in the old days, the big mining companies would take them out. And the problem for the juniors was that unless it was big, you had nothing. There was no consolation prize. So now we've entered a market where capital is becoming available for these juniors because of this huge education the sector underwent last year. Where the people went from the big mining companies and migrated to the juniors and started doing their stuff within the junior market. Now they have the credibility to attract the capital to go it alone. And that's what's going to be really fascinating in the next while, is the money going in to even put projects into production. And when this is happening, then of course we'll still see them disappear through the takeover bids.
And on this program in recent weeks, we've had quite a number of guests indicate that 2011 should and could be a very good year for Canadian junior miners who have kind of lagged behind in terms of performance and valuation. 2011 could be a great year for them. Agree?
I would agree. This is a year, we're right now at an inflection point where people are wondering, are we going to go now into a serious double dip recession? Or is the United States going to start getting some traction? China has pulled all the weight during the past 2 years. India has been lumbering along behind. If we now start seeing the American economy start firing on more than one cylinder, then the perception is going to go, at the very minimum, the existing metal prices are going to be here to stay for a while, because the overwhelming mine supply response that would glut the market and kill prices is not going to happen until 2015 and beyond. So this is a bit of a sweet spot we're entering in. We've had a significant V-shaped recovery from the bottom at the end of 2008, and I'm of the view that we are going to see this sector go to an unprecedented level.
Good news from our guest, John Kaiser, editor of Kaiser Research Online. Lots more ahead. Stay with us.
The Money and Wealth Show is archived online at talkdigitalnetwork.com.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com. Or phone me, Larry Ray, at 604-531-9639.
You're watching The Money and Wealth Show, archived online at talkdigitalnetwork.com. Here's your host, Sterling Fox.
Welcome back to the Money and Wealth Show. We're speaking with John Kaiser, editor and publisher of Kaiser Research Online. And John, I'd like to change gears for this segment of the program and talk about rare earths. It's an area that a lot of people are just beginning to hear about it. You've been talking about this subject for at least a couple of years, if not longer. So help us out here. What are rare earths, and why are we hearing so much about them?
Rare earths are that part of the periodic table that in high school you avoided like the plague.
Okay.
Words like neodymium, praseodymium, europium, terbium, dysprosium, stuff you wanted to know nothing about. And China ended up dominating the supply of this over the last 20 years. But during the last 20 years, new technologies have come along, new policies such as the clean energy policies, which have increased the demand for these rare earths exponentially. And China, which subsidized the cost by allowing very polluting type of production, therefore they made this stuff available very cheap to the rest of the world, marginalized all the other mines that existed in the world, and prohibited development of them as mines. And now China is curtailing its production, imposing export quotas so that its domestic users will have ready access to this stuff, and the rest of the world is freaking out because all kinds of plans are jeopardized by it, and these juniors had managed to pick up all these abandoned deposits found in the last 50 years and are now in a very special sweet spot because there is an incredible urgency now to developing to put these things into production pronto.
And they're all about new millennium products and technologies, from military applications to literally space-age toys that require these very, very specific rare earth metals, right?
Yes, and what makes them, we call them critical metals because they are really a small fraction of the cost of the end product. But the end product doesn't exist without the functionality bestowed by these critical metals, which is why the American military is now very concerned because they don't tell us what goes into its very sophisticated technology. They got used to just-in-time procurement where you just called up the traders. I need so and so much of this erbium stuff. Oh yes, here we have some, it costs so much right now. Wonderful. All of a sudden there is nobody to call up for anymore. And this is creating a serious crisis.
Do we have rare earths in Canada?
Yes, we do. There are several major deposits. There's the Nechalacho deposit owned by Avalon, which is the most advanced one. It's had a pre-feasibility study done, for which there's a 300-page report available on CDAR. There's the Strange Lake deposit in northern Quebec, Labrador, owned by Quest Rare Minerals. This is also a world-class size deposit. And then there's a smaller one called the Kippawa, owned by Matamak in southern Quebec, and this is a smaller scale solution to the problem. But all of them are potentially big, long-term solutions to this problem, and they are all right now doing what they can to advance these projects, doing the metallurgy, doing the definition drilling, doing all the cost discovery needed to find out what does it take to make this a reality.
Our guest is John Kaiser, editor of Kaiser Research Online, and John will have a final word for us in a moment.
The Money and Wealth Show is archived online at talkdigitalnetwork.com.
Gold Ray Resources Corp. is developing a gold mine in China. Identified resource, 175,000 ounces of gold down dip to the south of an existing 1,500 ton per day operating mill. Resource remains open down dip into the east and west. Trading symbol GOR on the Venture Exchange. Website goldray.com. Or phone me, Larry Ray, at 604-531-9639.
You're watching The Money and Wealth Show, archived online at talkdigitalnetwork.com. Here's your host, Sterling Fox.
And now with a final word on today's show, our special guest, John Kaiser.
Most speculators are momentum traders. To be a smart speculator, you need to know what your expectations are. And in the resource sector game, one thing to watch out for is the maximum upside for the stock. And you do that by figuring out the value of the metals in the ground, the gross metal value, and then relating it to the market cap of the company. And the market cap should never be close to the value of the metals in the ground, because the metals in the ground have to have capital costs and operating costs, and that's subtracted from it. So you need to do math in this sector if you want to be a serious speculator.
And you can find out lots more at KaiserResearchOnline.com. John Kaiser, thanks so much for joining us. A real pleasure to have you on the program.
Thank you, Sterling.
Our thanks also to Fritz and the crew here at Churchill's at the Holiday Inn in North Vancouver, once again for the terrific hospitality. For the Money and Wealth Show, I'm Sterling Fox. See you next time.
The Money and Wealth Show, brought to you this week by American Manganese Incorporated.